Fed tapering, a government shutdown, and last-minute debt ceiling deal rocked the bond markets in recent weeks. John Lothian News sat down with David Robin of Newedge to talk about what's next for the bond market and futures volumes.
My sense is that the drama that we went through this time around is not going to be as significant, but I think the significance of the debate itself and the process that the marketplace and the political theater underwent has sort of got the marketplace in a situation where we know that for any extended period of time, the Fed is really the only game in town. That fiscal stimulus, that the ability to come to some sort of grand bargain is not anywhere on the horizon. So to the extent that the debt ceiling crisis is going to reemerge, I don't think so. I think volumes are going to be moderate. I think that the marketplace, again, was kind of transitioning into an alternate world in late summer where they were waiting for the Fed to taper, that the environment would be somewhat different. There would be somewhat more of a two-sided, marketplace, which is always good for futures volumes. May not necessarily be good for the underlying portfolio, but is good for the risk management element of futures volumes. So now the marketplace is kind of transitioning back to kind of an old trade, buy and hold, one-sided, lower volatility. That's not great for volumes. So that scenario, I can't say that in terms of an exchange projecting futures volumes or a brokerage firm projecting futures volumes, we would necessarily be elevating our expectations in the foreseeable future. At some point in time, yes, the Fed is going to taper, that things are going to change. When that is kind of remains to be seen. So you've got that. Plus you've got the customers, again, in that evolving sphere of what they're trying to do, what they need to accomplish. Going back to the same old buy and hold trade is kind of really not where they want to go. So it's going to be a moderate volume, low volatility environment, probably until the beginning of the second quarter of 2014, when the Fed really starts to probably ramp things up again.